Today on Real Estate Backstage, social media is flooded with reports of a housing crash in the Washington, D.C. area, but the data paints a very different picture. The Department of Justice gets involved in Rex's lawsuit against Zillow. Phoenix Realtors and the National Association of Realtors have reached an agreement to bring the local association back in compliance with NAR's bylaws. Ron DeSantis wants to eliminate property taxes in the state of Florida. And a recent study shows that sellers who didn't list their property in the MLS left about $5,000 on the table on average. Now, before we jump into today's show, if you're watching on YouTube or if you're listening on Apple Podcast or Spotify, make sure to subscribe that way you don't miss any future episodes of the show. And you can find the show notes with links to all the articles that we referenced today at realestatebackstage.com/episode 19. Now, if this is your first time watching or listening, I'm your host. I'm Michael Smith. I'm the broker in charge CEO here at Bluefield Realty Group. We are a 3-time Inc. 5000 company headquartered here in Greenville, South Carolina. And we provide real estate brokerage, property management, and insurance services. All right, so today we're going to start with this story about Washington, D.C. So the claim is that massive layoffs of federal government employees is causing a housing market crash in the Washington, D.C. metro. But the data paints a very different picture. When you look at the actual numbers, things look very, very normal. So if you're watching on YouTube, I'm going to put a couple graphs up on the screen. This is courtesy of Redfin. This first one here is the Washington, D.C. metro specifically. Now, the black line is 2022, the blue line is 2023, the yellow line is 2024, and the green line is this year, 2025. So you can see that the number of new listings hitting the market is very, very normal. It is up slightly from last year, but that is just a continuation of a trend. So inventory levels in 2022 were much higher than they've been the last couple of years. And then in 2023, they were rather depressed. They grew slightly in 2024, and it is growing slightly again in 2025. So again, the green line is this year, nothing out of the ordinary. The number of new listings hitting the market in the Washington, D.C. metro is up slightly compared to this time last year, but it is a very normal trend line, and it is still lower than the number of new listings that hit the market when you compare it to 2022, just a few short years ago. Now, this next graph for context is all metros across the country combined. So this is the overall United States housing market. So you can see the graphs look very, very similar. So there's really not much different going on in the Washington, D.C. housing market compared to other parts of the country and compared to prior years as well. All right, so moving on. The Department of Justice is getting involved in the Rex versus Zillow case, and their goal is to see the case escalated up to the appeals court. So this is according to Real Estate News. Quote, citing concerns that future trade associations could circumvent antitrust rules, the Department of Justice asked a U.S. Court of Appeals to set aside a lower court ruling related to NAR's no commingling policy, a rule which prohibits real estate sites that use IDX feeds from displaying MLS listings alongside non-MLS listings. Speaking to a panel of Ninth Circuit judges in Honolulu on February 13th, DOJ attorney Alice Wang argued in favor of vacating a 2023 jury decision involving Zillow, the defendant in the case, and the low-fee brokerage Real Estate Exchange, or REX. NAR was originally a defendant as well, but was dropped in 2023, unquote. All right, so a couple things I want to point out. So Rex originally filed this lawsuit back in 2021. Originally, both NAR and Zillow were named as co-defendants. And this was about NAR's optional no commingling policy that Zillow was complying with in their website. Now, this is an optional policy, and about 70% of the local MLSs across the country do implement this no commingling rule. Now, basically what that means, if you are a website that displays real estate listings and you are getting the data via an IDX feed, IDX is Internet Data Exchange. So if you are getting an IDX feed from this local association, this local MLS that has chosen to implement this no commingling policy, you cannot display the listings from that MLS alongside listings that are not from an MLS. Now, this, of course, makes the customer experience on the website a little less favorable, and that's why Zillow has actually been rather outspoken for many years against this no commingling policy. So if you think about it from Zillow's perspective, why would they want to make it more difficult for consumers to see listings on their website? Zillow doesn't really have a horse in this race, either for or against Rex or any other particular brokerage. Zillow's goal is just to provide a great customer experience so that people use their website so that they can generate leads to sell to real estate agents. So Zillow, like I said, they have actually been advocating against this no commingling policy for many years now. So it is interesting to me that Rex named Zillow as a co-defendant in this case. I think it would have made much more sense if they just brought the lawsuit against NAR, or maybe the specific MLSs across the country that chose to implement this no commingling policy. Right now, if you were to go to Zillow's website and you look through the active listings, you actually have to toggle back and forth between properties that are listed by an agent and properties that were listed off the MLS. So you can't actually see those listings together in the same feed. You have to toggle back and forth between two different pages, which in my opinion does make a rather poor experience for the customer. The customers just want to see all the available listings on the market. So Zillow did prevail in court in 2023. There was a jury trial, and Rex did not win. They did request a new trial, but that was denied in January of last year, 2024. But now the Department of Justice is getting involved, and they're really putting their weight behind this push to get the case escalated up to the Ninth Circuit Court of Appeals. So we'll keep an eye on that and see what happens. All right, so in other news, this is breaking just this past week. NAR and the Phoenix Realtors have reached an agreement which brings that local association in Arizona back into compliance with the NAR Constitution and the NAR bylaws. So this is according to RIS Media. Quote, the National Association of Realtors, NAR, today announced it reached a resolution with Phoenix Realtors that brings the local association back into compliance with NAR's Constitution and bylaws, allowing the local association to retain its charter. The two groups have been embroiled in a nasty dispute starting late last year regarding whether Phoenix Realtors members must stay with NAR in order to access MLS listings, with lawsuits threatened on both sides. Phoenix Realtors eliminated its MLS Choice membership option, but will continue to offer non-realtors access to the Arizona Regional Multiple Listing Service, as it has done since 1996. In addition, Phoenix Realtors will provide certain products and services to non-realtor licensees who purchase non-member MLS access. Phoenix Realtors emphasizes that non-member MLS access is not a membership of any kind, and licensees who purchase non-member MLS access are not realtors, may not use the realtor trademark, and would not belong to a local, state, or national realtor association, or have access to many benefits of realtor membership. The legal skirmish began December 18th when NAR said it was taking necessary action to defend its three-way agreement that requires agents to join local, state, and national associations and to enforce the NAR Constitution and bylaws. That action included sending a cease and desist letter to Phoenix Realtors, saying that their new MLS Choice purports to allow real estate licensees to become members of Phoenix Realtors without becoming a member of the Arizona Association of Realtors or of NAR. The matter was never about MLS access, according to NAR, and NAR said its policy on this has not changed. Phoenix Realtors ARMLS is and has long been open to non-realtors. MLSs have local discretion to determine individual participation requirements based on their market and applicable law. In a statement forwarded to RIS Media, NAR said that we are pleased to have reached this resolution, which protects the rigorous standards of the Realtor brand. We look forward to continuing to work with Phoenix Realtors in service of Realtors and our shared mission. Phoenix Realtors additionally issued the following statement. After working together productively, Phoenix Realtors and the National Association of Realtors have reached a mutually beneficial agreement that ensures Phoenix Realtors' non-member offering complies with NAR's Constitution, bylaws, and the three-way agreement. Following NAR's December 2024 cease and desist letter to Phoenix Realtors about MLS Choice, NAR initiated its charter revocation process, citing concerns that the offering conferred local association membership, caused confusion for consumers, and weakened the Realtor brand. To address these concerns, Phoenix Realtors and NAR worked together to clarify the marketing around MLS Choice and introduce an updated offering. The updated offering is known as Non-Member MLS Access, which will eliminate any further confusion and make clear what the subscription option entails, unquote. So for those of you who haven't been paying attention to this story, essentially the Phoenix Realtors, a local chapter of NAR out in Arizona, late last year, they came up with a membership option called MLS Choice. This is something that they were offering to local real estate licensees there in the area who chose not to become realtors. So they weren't actually joining the Phoenix Realtors, the Arizona Association of Realtors, and the National Association of Realtors, but they still wanted MLS access along with other benefits. And that's really the major differentiator there, because MLSs across the country, NAR-affiliated MLSs, actually do have discretion to offer MLS access to non-realtors, but there are some limitations there. So they can't actually call it a membership, and they have to make it clear that those licensees who choose not to be members of NAR cannot use any of the realtor branding or trademarks or anything like that. So they have rebranded this from MLS Choice. They're now just calling it non-member MLS access. I believe they've stripped out some of the additional offerings, like including some of these state created forms, like the contracts and addendums and things like that. NAR had been very aggressive in defending its three-way agreement here. They issued the cease and desist letter to the Phoenix Realtors last year, and they did actually initiate that charter revocation process. So if Phoenix Realtors had not come to this agreement with NAR and decided to make these changes to their MLS Choice membership option, they were actually going to lose their charter. They would be removed from the Realtor Association altogether. So that would have been interesting. All right, shifting gears, we could very well see the state of Florida eliminate property taxes. So this is according to Housing Wire. Quote, Florida Governor Ron DeSantis said that he wants to eliminate property taxes in the state. In a post on X, the governor said that taxing land and property is the most oppressive and ineffective form of taxation. Property taxes are local, not state, so we would need to do a constitutional amendment, which requires 60% of voters to approve, to eliminate them, which I would support, or even to reform or lower them. We should put the boldest amendment on the ballot that has a chance of getting that 60%. Though Florida's statewide budget mostly comes from the sales tax, property taxes fund critical services like police, fire, and schools. According to CoreLogic data, the median 2024 property tax in Florida was $3,101, a 9.5% increase over the prior year and up 47.5% from 2019. Property taxes have skyrocketed in South Florida in particular. Median property tax payments in Miami-Dade County have risen 56.8% since 2019, and they've jumped 56.8% in neighboring Broward County. Home price appreciation over that period has been 58.9% and 59.9% respectively. Broward experienced an 11.4% year-over-year jump in median property taxes last year, and Miami-Dade's rose by 9.9%. Nationally, the highest effective property tax rates in 2023 were in the Northeast and Midwest states, led by Illinois, New Jersey, Connecticut, New York, and Nebraska, Adam reported. Northeast states have 7 of the 10 highest average property taxes in 2023, Adam reported. New Jersey led the way at $9,488, unquote. All right, so a couple of things to point out here. So the state of Florida is one of only 9 states in the entire country that does not impose a state income tax on its citizens. This is because the vast majority of the revenue for the state comes from tourism. There are both sales taxes and development taxes related to tourism, and that funds almost all of the budget for the state of Florida. However, property taxes are levied at the local level, so county and city. And this is where they get funding for things like schools, libraries, fire departments, police offices, things like that. And if you take the ability away from the local governments to assess a property tax, those municipalities are going to have to come up with that revenue from somewhere else. It's not like they're going to just stop providing all of these services to their citizens. So likely what we would see if property taxes went away in the state of Florida is they would have to raise local sales taxes at either the county or the city level in order to make up for it. All right, shifting gears. Zillow recently did a study on the outcome that sellers can expect if they try to sell their home off the MLS. Now, this is according to Real Estate News. Quote, a new study from Zillow has found that off-MLS sellers left more than $1 billion on the table in 2023 and 2024. Yes, that was billion with a B, $1 billion. That translates to a typical loss of $4,975 per home, with losses in some areas reaching as much as $30,000 on average. This aligns with oft-quoted findings by Bright MLS and Drexel University, which found that homes listed through Bright sold for 18% more than homes not marketed on the MLS. It's also sure to add fuel to the debate over private listings and the Clear Cooperation policy instituted by NAR in 2020. Clear Cooperation requires publicly marketed homes to be listed on the MLS within 1 business day, and some leading brokerages have pushed back hard on this rule. For example, Compass CEO Robert Refkin has said that homeowners deserve to have more control over how their homes are marketed and how information is shared. To that end, the brokerage launched a 3-phase marketing strategy in November that encourages agents to pitch sellers on Compass's private exclusive channel before going out to the open market. Zillow CEO Jeremy Waxman, on the other hand, has taken a firm stance against private listing networks. Most recently, he wrote in a February 17th blog post that private listing networks limit a home's exposure to the market to the detriment of the seller. Make no mistake, this practice is designed to benefit a participating brokerage's own bottom line as an attempt to double dip on commissions from both sides of the transaction within their brokerage, Waxman wrote. And it comes at the expense of the seller, who is parting with what is often the biggest financial investment of their lifetime and not reaping the full benefit. Waxman also noted that agents are increasingly pushing clients to list on a private network. A January survey found that nearly 2/3, 63%, of the 2,000 consumers polled said that their agent encouraged them to list on a private listing network. That's up from 18% 5 years ago, unquote. So this doesn't surprise me at all. It makes sense that homes marketed on the MLS would tend to sell for a higher price because this is just common sense, right? Homes that get more exposure, the more buyers see your listing, on average, the more interest there will be, the more showings, the more offers, the higher the sales price. Now, I do believe that sellers should have a little bit more control over when, how, and where their homes are marketed. So I can understand the argument from that perspective of more consumer choice. There are some valid circumstances in which a seller might not want to put their property on the MLS, but they still want to sell. We've talked about this before on prior episodes of the show. I think there's a way that you can do this. Maybe you have the clear cooperation policy, but you create an option where a seller can specifically opt out. Maybe they have to submit something in writing explaining in their own words why they feel it is in their best interest to sell the home on a private listing network, internally within their brokerage without being put in the MLS. I think it's common sense that if you do that, you're probably going to sell for a lower price, but price isn't always the most important thing to a seller. Maybe speed, convenience, privacy, sometimes those things are more important, and maybe a seller is perfectly fine walking away with $5,000 less in their pocket for those particular reasons. So I understand what Zillow is saying here. And of course, Zillow, they have skin in the game here. They don't want private listing networks because they want those listings on Zillow. Again, so they can generate the traffic, so they get the eyeballs on their website, and so they can sell leads to real estate agents. So it makes sense why Zillow would have this perspective, but it makes sense why the study came up with the results that it did. All right, so we're going to wrap up with another segment of Ask Me Anything. This is where you guys ask questions and I answer them. If you have a question that you would like answered on the show, you can send an email to hello@realestatebackstage.com. Now, this week's question comes from Mark. Quote, I've heard that I should set up an LLC in order to save money on taxes. How does that work? Unquote. So let me preface this by saying I'm not an accountant, not an attorney, not a CPA. You should definitely seek the advice of a tax professional before you implement any tax strategy. But I will give you my 2 cents. So there's a common misconception that if you set up an LLC, you will somehow magically be able to write off more expenses than what you otherwise would. That's just not true. Any legitimate business expense that you incur can be deducted, can be written off on your tax return, whether you paid for that in cash, whether you paid from a personal account, whether you paid from a business account, whether it's a credit card, a debit card, doesn't matter how you paid for that expense. If you incurred that expense as part of doing business, you can deduct it. Again, I'm not an accountant, not a CPA. But just having an LLC set up doesn't mean that now all of a sudden you can write off your laptop or you can write off the lunch with a client. Like I said, any legitimate business expense that you incur, you can deduct whether you are operating as a sole proprietor or whether you have an LLC set up. That doesn't make any difference. The purpose of setting up an LLC typically is for liability, for asset protection. But keep in mind, if you're a real estate agent, if you're working under another broker, you are acting as an agent of the brokerage. So you're not acting in a personal capacity. You are acting on behalf of the brokerage that you represent. In reality, if you have a client, that is actually the client of the brokerage. So the brokerage is actually the agent of the buyer or the seller, and then you are a sub-agent of the brokerage. So there's kind of an indirect relationship there. You represent the brokerage, and the brokerage represents the buyer or the seller. So if you were to get sued by a client, they're really suing the brokerage 9 times out of 10. If you get lumped in as a co-defendant with a lawsuit that involves your brokerage, you could, of course, ask the judge to dismiss you from the case, and you could just make the argument that you're acting as an agent of the brokerage and you shouldn't personally be named in the lawsuit. And that, like I said, not an attorney. Even if that doesn't work, though, you're going to be covered under the professional liability insurance policy of your brokerage, the E&O, errors and omissions policy. Side note, you do want to make sure you have a conversation with your broker and understand what their policy is. Make sure you are covered by that professional liability policy and see what their specific internal brokerage policy is on the deductible. If they get sued by a client that you worked with, are they going to pay the deductible? Do they expect you to pay the deductible? Is there some type of split there? A lot of people don't know to ask that question when they're talking to a brokerage, when they're trying to decide what company they want to work for. So for example, here at Bluefield Realty Group, we cover the premiums and we cover the deductible if a claim is ever filed. But there are some other companies out there that do require the agent to pay some or all of the deductible if they are sued by one of that particular agent's clients. All right, so getting back to the whole tax savings thing. Like I said, just setting up an LLC is not magically going to save you money on taxes. You can still write off all the same normal business expenses. However, the real magic happens with an LLC when you take that extra step and you elect S-Corp taxation, S-Corp status for that LLC. So LLCs are what we call disregarded entities. When you set up an LLC, you get to choose how the IRS treats that company. You can choose to be taxed as a sole proprietor. You can choose to be taxed as a C-Corp. You can choose to be taxed as an S-Corp. Now, if you elect S-Corp taxation for your LLC, and then you actually pay yourself a salary from the company, so you're going to put yourself on a W-2 from your own company. Basically, the way it works is you pay yourself a normal customary salary, and then the rest of your income is considered distributions. So if you're a real estate agent and you're making, let's say, $150,000 a year, maybe you put $50,000 of that as a salary on your W-2, and then you take the other $100,000 as distributions. Now, the real benefit here is that only the portion of your income that's designated as salary is going to be subject to the FICA payroll taxes. The rest of your income that's designated as a distribution, you are not going to pay those payroll taxes on. Now, typically when you're self-employed, if you file as a sole proprietor, you're going to pay those payroll taxes on all of your income. So this is a way to minimize your tax burden, but it's not just setting up the LLC. You actually have to take that extra step of electing the S-Corp taxation status and then paying yourself a salary through a W-2. Like I said, I'm not an accountant, not a CPA. Make sure to talk to your tax professional before you implement this. But typically from what I've seen, when you start earning more than like 50, 60, 70,000 per year in income as a real estate agent, that's kind of like the tipping point where it starts to make sense to look at the strategy. If you're making less than that, it's, the cost savings, the tax savings is not going to be worth the extra time, headache, and expense of actually setting this all up. But certainly if you're making six figures, you will, again, not an accountant, but you are going to save money by doing this. All right, y'all, that's a wrap for today. Just a reminder, you can find the show notes with links to all the articles that we referenced today at realestatebackstage.com/episode 19. And I'll see you here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.